Hey guys, it's Adrian here, the Canadian in a t-shirt, and today I'll be breaking down what is an RRSP and how to invest in your RRSP to minimize your tax bill and maximize your long-term growth. I'll go over the benefits of an RRSP, the contribution limits, and the rules regarding tax deductions. And in part 2 of this video, I'll go over RRSP withdrawals, and I'll talk about what kind of investments you should hold in your RRSP to maximize your tax efficiency. This is the third chapter in my Canadian tax guide, and I'll be assuming that you have a basic understanding of taxable income, tax brackets, and deductions. If you need a refresher on how Canadian taxes work, click the pop-up at the top right to check out my previous videos on Canadian taxes. Throughout this video, I'll be comparing the RRSP to the TFSA, the tax-free savings account. So make sure you check out my TFSA video first and then come back to this one. An RRSP stands for Registered Retirement Savings Plan, and it is one of the most important tax-sheltered accounts offered in Canada, along with the TFSA. The RRSP was designed to help Canadians plan for their retirement, so it is meant for long-term investing. And just like with the TFSA, the RRSP's name is misleading. The Registered Retirement Savings Plan is indeed meant to grow your retirement fund, so the first half is correct. But it should not be used as a savings account. The RRSP should be used as an investment account. Investing in an RRSP offers two main benefits. One, it allows you to defer your taxes to a future year, ideally when you retire. Basically, when you put money into an RRSP, you are able to reduce the amount of taxes you pay this year and delay those taxes by 30 years until you retire. At that point in retirement, you should have a smaller income, you would be in a smaller tax bracket, and so you would pay less in taxes. The second benefit of an RRSP is that it allows your investments to grow tax-free. The RRSP is tax sheltered, so any income you earn inside your RRSP will not be taxed. So any dividends, interest, or capital gains you make will be tax-free, and so your investments will grow much faster inside an RRSP than they would in a non-registered account. The tax-sheltered nature of an RRSP is very similar to the TFSA. The main difference is that with an RRSP, you reduce your taxes today, and so you have more initial money to invest with. But you will have to pay taxes years later when you withdraw that money out of your RRSP, hopefully during retirement. This is a common misconception. You can't buy an RRSP. An RRSP is not a product that you buy at a bank. An RRSP is a type of account where you can hold almost any form of investment. Just like with the TFSA, think of an RRSP as a large umbrella where you can hold stocks, bonds, ETFs, mutual funds, GICs, REITs, and cash. As long as these assets remain inside your RRSP umbrella, you won't be paying any taxes on them. You only pay taxes when you withdraw this money outside of the RRSP. I want to stress this point. Just because you can hold cash in your RRSP, please don't use your RRSP as a savings account. The main benefit of an RRSP is that it reduces the tax you would normally pay on investment income. Using a savings account, you will earn at best a 2% interest rate, and that essentially keeps up with inflation. It barely gives you any income, and so you would barely be paying any taxes on it anyway. So keeping a savings account in your RRSP is a waste of your limited room. The income you earn from stocks and ETFs will far surpass this tiny 2% interest rate. So if you hold these investments inside your RRSP, you will gain a much greater tax benefit. Stick around for part 2 of this video where I'll share my strategy for what kind of investments to hold in your RRSP to maximize your tax-free growth. But first, I want to go over the rules of an RRSP. So who can open an RRSP? As long as you live in Canada and you've earned Canadian income in previous years, you can open up an RRSP. There is no minimum age requirement. With the TFSA, you have to wait until you're 18 years old, but RRSP contribution room starts building the year after you start earning money. If you're 15 years old and you have a part-time job, you can't open up a TFSA yet. But next year, when you file your taxes, you will now have RRSP room, and so you can open up an RRSP account to start investing with. RRSP contribution room is based on the income of previous years. So if you just moved to Canada, even if you have a job right away, you'll have to wait until next year to open up an RRSP. There is no minimum age requirement, but there is a maximum. You have to be under the age of 71 to open an RRSP or to contribute to an RRSP. For TFSA, the contribution rooms are very simple. Your room only depends on your age, but RRSP contribution room depends on your income. Every year, your RRSP contribution room will increase by 18% of your earned income in the previous year, but it's capped at a maximum amount. In 2019, that maximum value was $26,500. And for 2020, the max value was increased to $27,230. So if you earned $100,000 last year in 2019, This year in 2020, you will have gained 18% or $18,000 of RRSP contribution room. But if you earned $200,000 in 2019, 18% of that is $36,000, and that is above the maximum amount. And so your contribution room for 2020 would be limited to the maximum amount of $26,500. So what counts as earned income? Your earned income includes your pre-tax employment income, your net business income, your net rental income, and disability income. Note that investment income is not considered earned income, and so it is not used in your calculations. As an example, if your salary is $60,000 as reported in your T4 slip, and you have a side business with $10,000 of income and $3,000 of expenses, your net business income is $7,000. And let's say you have a rental property giving you a net income of $8,000. Adding this all together, your earned income of 2019 is $75,000. We take 18% of this total, and so our RRSP contribution room for 2020 will be $13,500. Just like with the TFSA, any unused contribution room will be carried forward to future years. So don't worry if you can't fill up your RRSP this year. You won't be losing any room. If you don't want to keep track of these numbers and do these calculations by hand, you can find your total available contribution room after you file your taxes by checking your notice of assessment. And you can find this by logging into your CRA account online. At the bottom of your notice of assessment, in the RRSP section, you will see your total available contribution room for the upcoming year. You'll see that your total available room is unused room from previous years, plus the new contribution room you earned this past year. If you made any RRSP contributions, that amount will decrease your available room. An RRSP contribution includes money you put into an RRSP, but it also includes pension adjustments. This is an important point. If your employer offers an RRSP or a pension plan matching program, then your employer's contribution will also reduce your available room. So if I put $5,000 into my job's pension plan, that $5,000 counts as an RRSP contribution. But if my employer matches my pension plan contribution, they also put in $5,000. So my total available room has decreased by $10,000, even though I only put $5,000 of my own money. This is still a great deal though. My employer is matching my RRSP or pension plan contributions, and that's free money. Just make sure that you are including your employer's contributions when you calculate your available room for the year. Here's another source of confusion. In your notice of assessment for 2019, for example, you'll see two different numbers: your RRSP deduction limit for 2020 and your available contribution room for 2020. These are not the same thing, although oftentimes they will be equal numbers. Whenever you make an RRSP contribution, you can use that money to deduct your taxable income and get a tax refund. But you don't have to claim that tax deduction right away. If you're at a low income and you know that your income will increase significantly next year, then it would be a good idea to carry forward that contribution amount and deduct it next year. That way, next year, you would receive a far greater tax refund than you would if you claimed that deduction this year. I'll go into more details on this strategy later in this video. But basically, your deduction limit will be your total available contribution room plus your unused contributions from previous years. But if you always claim your RRSP deduction right away, then your deduction limit and your total available room will be equal. Make sure you record every single RRSP contribution you make throughout the year. You don't want to exceed your available room, because if you do, the penalties will be severe. If you exceed your RRSP contribution room, you will be charged a 1% fee every single month on this excess amount. This equates to a 12% annual fee, which is massive, so make sure you stay within your limits. Technically, the government allows you to contribute $2,000 above your contribution room before you get penalized. However, this wiggle room is meant to protect you in case you make a mistake. This $2,000 amount cannot be deducted from your taxable income, so try to avoid using it. Let's say I forgot to keep track of my RRSP contributions, and I added $12,000 to my RRSP after I was already maxed out. I won't pay any penalties on the first $2,000 in excess, but I also can't claim this $2,000 to deduct my taxes. But I still have another $10,000 above my limit, and so I will be charged 1% or $100 every single month until I withdraw that excess amount. Just like with the TFSA, you can open multiple RRSP accounts with different financial institutions. You can have an employer RRSP plan with Manulife, for example. You can open up an RRSP account with a bank like BMO, or what I suggest, you can open up an RRSP investing account with QUESTRADE to hold stocks and ETFs. There is no limit on the number of RRSP accounts you can hold, but the total amount you've contributed to all of your RRSP accounts cannot exceed your contribution limit. And here's another important point. Any income you earn inside your RRSP, such as dividends or capital gains, these do not count as contributions. Only money you put into your RRSP from outside counts as a contribution. So if you've maxed out your RRSP and then you receive $10,000 in dividends, those dividends are totally safe and tax-free. Those dividends won't push you over your limit, and so you won't pay any penalties on it. But you will have to pay taxes on those dividends eventually when you withdraw. So those are the rules for contributing to your RRSP. Now let's get to the fun stuff, the benefits of investing in your RRSP. Your RRSP contributions allow you to reduce the amount of taxes you pay right now and defer these taxes for 20 or 30 years down the line when you withdraw this money during retirement. This is especially useful in your working years when you have a high income and you are in a high tax bracket. You can save a huge amount of money by delaying these taxes until retirement, when your income is lower and thus your tax rate will also be lower. Essentially, contributing to an RRSP is a deal you make with the government. You're saying, I don't want to pay a large tax amount right now. I'll delay these taxes by 30 years and pay a much smaller tax amount when I retire. So let's go through an example. Here are the federal tax brackets of 2020. So you'll be using these numbers when you file your taxes in 2021. For simplicity, I'm not including provincial taxes. We're only looking at federal taxes here. Let's say I have an income of $45,000 per year. Our full income falls into the first tax bracket since our income is less than $48,000. So we pay a marginal tax rate of 15% on our $45,000 income. And so we pay $6,750 in taxes. But what if we contributed $10,000 to our RRSP? That reduces our taxable income by $10,000. So now our taxable income is only $35,000. Again, this full amount falls into our first tax bracket. We pay 15% taxes on this $35,000, giving us a tax bill of $5,250. You can see that if we contribute $10,000 to our RRSP, our tax bill has decreased by $1,500. If you've been paying taxes off of every paycheck, that means you've already paid the full tax amount of $6,750, but after claiming our RRSP deductions, we only owe $5,250 in taxes, and so we have overpaid. When we file our taxes and claim that $10,000 RRSP deduction, the government will pay us back. They'll give us a refund of $1,500. That's awesome, but we're still in the lowest tax bracket, and so we are getting the smallest possible benefit from this RRSP deduction. Remember, just because I contributed $10,000 to my RRSP this year doesn't mean I have to claim this deduction right away. I can carry forward that deduction to a future year when I'm in a higher tax bracket, and so I will get a larger tax refund. So let's look at an example. I contributed $10,000 to my RRSP, but I expect that next year my salary will increase to $65,000, and that will bump me up to a higher tax bracket. Let's see what kind of tax savings I can achieve if I defer this $10,000 deduction until next year. Okay, so now my income is $65,000. I completely fill up the first tax bracket of $48,535. I pay 15% in this bracket, so I'll pay $7,280 in taxes. The remainder of my income goes into the next tax bracket, but we don't quite fill it up. We only have $16,465 left to put into this bracket. The tax rate in this bracket is higher at 20.5%. So for our $16,000 in here, we'll pay $3,375 in taxes, giving us a total tax bill of $10,655. Now let's see what would happen if we claimed our $10,000 RRSP deduction that we chose not to claim last year. This reduces our taxable income by $10,000, so our new taxable income will only be $55,000. When we reduce our taxable income using deductions, it reduces our income from the highest tax bracket first, and we work our way down. That means that our first tax bracket won't be affected. We still fill it up to the max, and we pay the 15% tax on this bracket. In the second bracket, we should have $16,465 to pay taxes on. But with our RRSP deduction, we reduce this amount by $10,000. So we only have $6,465 in this bracket. Now we pay a 20.5% tax rate on this smaller amount, giving us $1,325. Our total tax bill is now $8,605. So our tax bill has decreased by $2,050. So let's compare. If we claimed our $10,000 RRSP deduction last year with a small income of $45,000, we would get a tax refund of $1,500. But if we deferred this deduction until next year when we have a larger income of $65,000, that same $10,000 RRSP deduction gives us a larger tax refund of $2,050. That's an extra $550 for free just for waiting 1 year. Remember, this is just looking at the federal taxes. If we include provincial taxes, the differences in tax savings will be even greater. Let's look at an extreme case to drive this point home. What if next year, my income made a huge jump to $110,000? As before, I completely fill up my first tax bracket of $48,535. I pay 15% tax in this bracket, so I'll pay $7,280 in taxes. I also completely fill up the second tax bracket of $48,534. I pay 20.5% of this, giving me $9,950 of taxes in this bracket. Now my remaining income goes into the third tax bracket. I have $12,932 remaining. I will pay a much higher tax rate here of 26%. So I pay $3,362 of taxes in this bracket. My total tax bill will be $20,592. Now let's see what happens if we claim our $10,000 RRSP deduction this year with this high income. Again, the $10,000 deduction affects the highest bracket first. So our first bracket will be unchanged. We'll fill it up to the max and pay 15% on this. Then we fill up the second bracket and we pay 20.5% on this. In our third bracket, we would have $12,931, but we are reducing this taxable amount by $10,000. So we only have $2,931 in this highest tax bracket. And we pay 26% on this. So we'll only pay $762 in the highest tax bracket. This gives us a total tax bill of $17,922. That reduces our taxes by $2,600. Comparing this with our $45,000 income, if I claim a $10,000 deduction out of $45,000 income, I get a tax refund of only $1,500. But if I chose to wait and make the exact same deduction at a higher income of $110,000, I get a much larger tax refund of $2,600. That's an extra $1,100 just for waiting and claiming this deduction in a later year. Of course, this is an extreme case. It's very unlikely that your salary will increase from $45,000 to $110,000 in a few years. But I hope this example illustrates why you shouldn't just claim your RRSP deductions right away. It's definitely worthwhile to consider if your salary will increase significantly in the next year or two. So if you have a low income, don't be afraid to put money into your RRSP to take advantage of that tax-free growth, but you don't have to claim that deduction right away. It might save you a lot of money to carry forward that deduction to a future year when you're at a higher tax bracket. But you have to plan ahead and run some numbers. Just because your income will increase next year, it doesn't mean that you'll be in a higher tax bracket. And if you're in the same tax bracket next year, then deferring your RRSP deduction won't actually save you any money. It would actually be better to claim your deduction this year. Let's go through a quick example. We already talked about the case if you have a $65,000 income and you contributed $10,000 into your RRSP. But what if next year you get a $10,000 salary increase? Should you claim your deduction now or should you hold it off until next year? Here are the numbers on the left with a $65,000 salary, and on the right is a $75,000 salary. Both of them have a $10,000 RRSP deduction. You'll notice that in both cases, this deduction would give you the exact same tax refund of $2,050, even though your salary would be higher next year at $75,000. This is because at both salaries, you are in the same tax bracket, and so you're paying the exact same marginal tax rate of 20.5%. So if you reduce your taxable income by $10,000, you'll be saving 20.5% of that, which is $2,050. Even with a higher salary next year, you won't be saving any money by delaying your deduction because you'll still be in the same tax bracket. So in this case, it would be better to claim your RRSP deduction right away and use that tax refund to invest, giving your investments a whole extra year to grow and pay out dividends. Again, in this example, we only considered federal taxes. If you include provincial taxes, you might actually be in a different tax bracket between the $65,000 salary and the $75,000 salary, depending on your province. And remember, these tax savings are actually tax deferments. You reduce your tax bill this year, but when you finally withdraw that money 20 or 30 years from now, you will have to pay taxes on that withdrawal. But you should only plan to do this during retirement when you're at a lower tax rate. I'll cover all of the rules for RRSP withdrawals in part 2 of this video, so stay tuned for that. So there you have it. That's the first half of everything you need to know about the RRSP. There's a lot to talk about with the RRSP, and there's no way I could put this all in one video. As a quick summary, the RRSP is a tax-deferred account designed to help Canadians invest for their retirement. It allows you to reduce your tax bill this year or in the future and defer those taxes for years until you finally withdraw that money during retirement. The RRSP also allows your investments to grow tax-free. You build RRSP contribution room every year based on your income. There's no minimum age, but you have to be below the age of 71 to open or contribute to your RRSP. I'll be releasing part 2 of my RRSP guide in the next few days. And there, I'll be talking about the rules regarding withdrawals and what kind of investments you should hold in your RRSP to maximize your long-term tax-sheltered growth. Since we're in the middle of tax season and Canada's tax deadline was extended to June 1st, I'm going to be making a lot of videos on Canadian taxes in the next few weeks, including a step-by-step guide on how to file your own taxes using TurboTax. I've been using TurboTax for the past 7 years, and they do a really great job of guiding you through the whole process in a way that anyone can file their own taxes, even without my help. If you want to get started with TurboTax, click my referral link in the box below, and you'll get 15% off any of their software products. Plus, I'll get a small referral bonus as well. Using my link, you can get a standard tax return for $17. To be honest, this standard version is all you really need. TurboTax also offers more advanced versions designed for landlords, business income, and investment income, but you can still handle all of that within the standard version. The premium versions will guide you and hold your hand a little bit more, but they are more expensive. For a free alternative, there's also SimpleTax, which is quite popular and it's paid entirely out of donations. But I haven't personally used it. I can't personally vouch for it, but it was recently acquired by Wealthsimple, so I'm sure it's pretty good. If you guys are interested, I can get myself a copy and make a video comparing TurboTax and SimpleTax. I'll go into more details in my upcoming tax filing videos. I just wanted to lay out these options in case you're planning on filing your taxes in the next few days. Remember, the deadline for filing your taxes has been extended to June 1st, but the sooner you file your taxes, the sooner you'll receive that tax refund. Thanks for watching, guys, and be sure to like, comment, and subscribe if you found this video helpful. Every thumbs up and comment really does help me build this channel, and hit that bell icon to be notified of my new videos every week. And if you'd like to follow me on Instagram or Facebook at CanadianTShirt, click the link in the box below or click the links on my homepage. And be sure to tune into my next video, part 2 of my RRSP guide, where I'll be breaking down how to invest in your RRSP to maximize your long-term growth. Thanks everyone, and I'll see you guys on the next episode of the Canadian in a T-shirt. Bye guys.